Welcome to this Killick Explains video. This is actually the third in a suite of 3 dealing with ways that employers can incentivize employees to become owners in their business. And if you've not seen the others, one is on Save As You Earn schemes, another is on share incentive schemes, and this is on employee share option schemes. So quite a bit of jargon and quite important to make sure that you've got, if you like, the right video for the scheme you're being offered. So what's the background to this one? Well, here employees may receive share options as part of their employment package, and there'd be no reason not to want these things, normally if your employer offers them to you. Some companies do, some don't. And these can be valuable, as we'll see in a moment, and also tax efficient, income tax efficient in particular. Plus, of course, they align you with your employer, which is why employers want to offer them, because you've got a benefit which is driven in terms of its value to you by what happens to your firm subsequently. So how do they work, and what are 1 or 2 of the things to watch out for? Well, first of all, the basic mechanics. Now, these are probably the most complicated of the 3 schemes I've looked at, but not too bad to get your head round with a numeric example. So the basics are what? Share options can be granted, first of all, to pretty much whoever the company chooses. So these might be limited to directors, some employees, or all employees. And if you're an employee who doesn't qualify, it'd be worth finding out at what level you might qualify, because these can be quite valuable. For employees, the maximum value that can be awarded is £30,000 per employee, and I'll come back to how that works in just a moment. And the options are granted at what's called the market value of the firm's shares. And the reason they're valuable will become apparent if, over the life of holding the options, if you like, unexercised, the firm's share price increases, then you can lock in a potential gain. So a basic example will help to illustrate what I mean by that. So imagine you are granted 6,000 share options when the share price of the company you work for is £5. So there is that maximum value I mentioned of £30,000. Good news, 3 years later, the options have sat there. The options are like a right to buy the company's shares at an agreed price. So 3 years later, the firm's share price is £8. And that is good news. What could you choose to do next? Well, the obvious thing to do, as we'll come back to in a moment, will be to exercise. So you got granted these options when the share price was £5. 3 years later, it's £8. But what else could you choose to do next? So you could exercise the options for an income tax-free gain of £18,000 right there and then. That would be 6,000 options times £3. Why £3? Well, because basically you get the difference between the share price when the options are granted and when they're exercised. So 8 versus 5. You could keep the options and wait. So you might think, well, actually, the company's share price has risen and it could go further. But there's a but. Things to watch out for. Now, first of all, the income tax exempt window that I mentioned is restricted. The minimum holding period to get that exemption is 3 years, but the maximum is 10. So a reasonably wide window, but you've got to keep an eye on at what point you need to have exercised the options to get that benefit. There'll be capital gains tax to pay on any gain on exercise over the exemption limit. That's £12,300 in 2020-2021. Now, there are ways to mitigate capital gains tax, and that's a reasonably generous annual exemption. So capital gains tax won't trouble a lot of people with share options, but it is something you have to bear in mind. And holding on to the options, of course, leaves you exposed to subsequent share price falls. So if you choose not to turn the options into shares, on the basis that they might become more valuable as the company's share price rises, you are taking the risk that things could go wrong for the business and could therefore leave you with options which are less valuable or even not worth exercising at all. So is this a nothing to lose deal? Well, no, there are some decisions to be made. So share options, yes, they're a free extra perk. I mean, normally you wouldn't turn them down as such. However, their value is uncertain until they're exercised. So until you exercise the option, you don't know what that locked-in gain is going to be, potentially. And it's best, therefore, not to rely on these things to meet what we call a foreseeable call on capital. In other words, people can be tempted as they see the value of the options rise as the company's share price rises to think, great, this is some kind of guaranteed bonus. But until the options are exercised, and until the underlying shares that you then buy are sold, don't bank on that particular gain. That can be dangerous. So a few considerations as we head towards the end of the basic share option scheme part. If you keep the shares on exercise, bear in mind they may subsequently fall in value. So what some people will choose to do is exercise the options and then sell the shares pretty much straight away, and therefore that risk is then taken out, if you like. There is, if you hang on to the shares, a risk of over-concentration, of course. I've talked about this in other videos, but depending on what other assets you hold, just be careful, because you might build quite a big benefit up in the form of share options. You then exercise them, you've got shares in your employer. Just be careful, because your future fortunes are then tied personally quite heavily into your employers. And there's always a risk with shares and share options of future capital gains tax complications. Now, there are ways round capital gains tax, so don't let the tax tail wag the dog in terms of making decisions, but nonetheless you need to be aware of them. Now, just to finish off, I want to mention an alternative to our basic share option scheme, and that's a thing called an enterprise management incentive scheme. Now, to be part of one of these things, you need to work for a certain kind of company, and you need to be a qualifying employee, if you like. So the type of company would need to be fairly small. So this might be a small, fast-growing business, hopefully, assets of less than 30 million and employees below 250, whereas the other scheme I mentioned is available much more broadly. The option limit here is £250,000 over 3 years, so quite a bit higher than the basic share option scheme I mentioned, and these again can be offered to some or all employees. So you need to find out whether you're eligible and under what circumstances you might become so. In essence, once again, no income tax or national insurance contributions are payable on the grant or exercise of the options. The basic mechanics are reasonably similar to the broader scheme I mentioned. There is CGT, capital gains tax, payable on any gains made over the annual exempt amount, which is the same for this scheme as it was for the other one. And there are similar practical risks. So there's always uncertainty over the value of the options until they're exercised, so there's the kind of use or wait dilemma. You could end up over-concentrated, particularly if you get the maximum award, if you like, and therefore watch out for that. And also you need to think about future tax implications depending on the decisions that you take. Quite a lot of ground covered there, two quite meaty schemes. So any questions, editor@killick.com, and if you're wondering about those other two videos on save as you earn schemes and share incentive plans, then it's killick.com/learn and the tax effective savings tab.